Hey traders, in this video we are going to learn the exact way on how to make $100 per day by just trading this one single pattern. So without further ado, let's dive right into it. Now, the pattern that we're talking about today is called the 3-bar pattern. So what exactly is the 3-bar pattern? It is a high win rate candlestick pattern that is characterized by having 3 consecutive bars: an igniting bar, a pullback bar, and a confirmation bar. Once this sequence of candles appear in a chart, it is usually followed by the price forming a strong trend afterwards, which we could take advantage of. And so the idea is that if you could just spot this pattern and trade this specific setup on a daily basis, it's very possible that you can make $100 per day using this strategy. And in this video, you're going to learn exactly how to identify the pattern, evaluate the trade setup, and know when to enter and exit the trade. Next, I'll also give a quick rundown on the proper risk management that you should use, because evidently, no chart pattern has a 100% win rate. So let's begin. But first, how do we actually spot the 3-bar pattern? So, in either direction, the pattern must exhibit 3 consecutive candlesticks. The first candlestick is called an igniting bar, which is a candlestick with a large body that signals strong momentum. The second candlestick is called pullback bar, which is a small candlestick with an opposite color of the igniting bar. Ideally, the overall size of the pullback bar should not exceed half of the igniting bar's body. The third candlestick is called the confirmation bar, which is a medium to large sized candlestick that closes above the pullback bar. Once the sequence is complete, you can enter a buy position at the confirmation bar's close. Let's see how this would look in a real chart. So here, we can see a green candle with a large body that formed, which is an igniting bar, followed by a small red candle, which is our pullback bar. And then, we have a green candle that closes above our pullback bar, which is our confirmation bar. And so, because the momentum of this sequence is heading upwards, it indicates that this is a bullish 3-bar pattern. And so we take a long position at the close of the confirmation bar. And after the pattern has formed, notice that the price made a nice uptrend. So that would have been a good long entry opportunity. Let's look at another example. Here, we have a nice red candle with a large body, signaling a strong downwards momentum, which will be our igniting bar. Then, it is followed by a small green candle, which the size does not exceed half of the igniting bar's body. This will be our pullback bar. Next, we also have a red candle that closes below it, which is our confirmation bar. In this case, it is a bearish 3-bar pattern because the momentum is heading downwards. And so we could open a short position at the close of the confirmation bar. And we can see that the price made a downwards movement after the pattern has formed. So, when traded correctly, the 3-bar pattern is a very simple and high win rate strategy. However, there are mistakes that traders tend to make when trading this setup, which could lower its win rate and cause them to lose money instead. And so, to make sure that you don't fall for these common mistakes, I'll be showing you how to avoid them. Mistake number 1. So, we know that an igniting bar is the first candle that forms in a 3-bar pattern, and it's also the most important. Reason being is that it shows that high liquidity is present. So in order for an igniting bar to be valid, it needs to have a large body. And so the mistake that traders usually make is that they try to force an igniting bar even if it's not there. Remember, if the candle's body isn't significantly larger, then it's not an igniting bar. Here's an example. In this chart, we can see what looks like at first glance a 3-bar pattern, because we have a green candle, a small red candle, and another green candle. But in reality, this is not a good 3-bar pattern setup, because the supposed igniting bar doesn't have a large enough body. And if you compare it to the previous candles, it has a relatively similar size. Remember, an igniting bar needs to be significantly larger than the rest of the candles. So if you have one candle that doesn't fit the criteria of the pattern, don't risk a position. Now here's an example of what a valid 3-bar pattern looks like. As you can see in this setup, the igniting bar clearly has a large body. And notice how it's significantly larger than the previous candles that formed. Mistake number 2. On some occasions, a 3-bar pattern may form after the price had already made a sharp movement in a short period of time, like in this example. And so this is generally not an ideal setup to enter long positions, because quick sharp movements like these are generally not sustainable and will result in a pullback. However, patterns that appear in the middle of a clean trend is much more valid. So a clean trend can be identified by the price gradually heading towards one direction, like in this example. Remember, the keyword here is gradual. It's not a sharp movement. In this case, the trend tends to be more sustainable. Now, before we move on, if you like this video so far, kindly hit the like and subscribe button. It only takes 2 clicks, but it means so much to me. Now back to the video. Advanced 3-bar pattern strategies. Now, although the 3-bar pattern is a powerful strategy, there's still so much room for improvement. You can actually combine the 3-bar pattern with other complementary strategies to further increase your chances of profitable trades. Advanced strategy number 1. 3-bar pattern plus trend confirmation. One of the strategies that consistently gave me a high success rate is by combining the 3-bar pattern with a trend confirmation indicator such as the exponential moving average. So let's look at this chart as an example. Here, we have a 50-period exponential moving average applied onto our chart, which acts as our trend confirmation indicator. And so, this indicator can now help us by making sure that we're not trading against the main trend. If the price is below the indicator, it indicates that the overall market is on a downtrend, meaning we only look for bearish 3-bar patterns. And if the price is above, we would only look for bullish 3-bar patterns. And so, the idea behind this strategy is we want to trade the 3-bar pattern while following the main trend. Like in this example, we had a bearish 3-bar pattern that formed while the price is below the moving average. So this is a good opportunity to enter short. Now for your risk management, you can place a stop loss above the pullback candle's wick and set a profit target at 2 times stop loss. Advanced strategy number 2. 3-bar pattern plus key levels. Another strategy that you can use in combination with the 3-bar pattern is by applying key price levels such as support and resistance. Let's observe this chart as an example. Here, we can see that the price went down to this level, consolidated as it failed to break below this area multiple times before bouncing upwards. And so we can actually draw a support level below this area to remind us that there's strong buying pressure. Next, as the price approaches that previous key support level, it failed to break through it once again, and we can see that the price slightly bounced upwards while forming a bullish 3-bar pattern. So what this setup tells us is that, first, price have bounced upwards after hitting this level in the past, and now there's a potential that it might do so once again. And because we have a bullish 3-bar pattern that formed, it further strengthens the idea that it may bounce upwards once again. So this is now a good setup to enter a buy position. For your risk management, you can place a stop loss slightly below the pullback candle and set a profit target at 2 times stop loss. Advanced strategy number 3. 3-bar pattern plus breakout. Another method for combining key levels with a 3-bar pattern is by looking for breakout opportunities. Let's look at an example. In this chart, we can see that the price is moving sideways and is forming a channel pattern as it hovers between these 2 support and resistance areas. Next, we can see that the price breaks out below the support level of our channel while also forming a bearish 3-bar pattern. Now, generally, if price breaks out of a channel, it tends to move sharply towards the direction of that breakout. And in this case, it broke the channel to the downside while also forming a bearish 3-bar pattern, which further supports the idea that the price may break out to the downside. And so this is a good opportunity to take a short position. Next, a stop loss could be placed above the pullback candle and a profit target at 2 times stop loss. And so, with all the strategies that you've learned about the 3-bar pattern, how much capital do you actually need in order to make $100 per day? Here's a complete breakdown. But first, you need to understand that the process of making $100 per day would not look like this. It would realistically look more like this. You will have some winning days and some losing days, and the idea is to aim for more winning days than losing days. That's why it's important to only choose the best setups when trading this pattern. So, to make $100 per day, you realistically need to have around $5,000 in total trading capital. And for beginners who don't have $5,000, you can always adjust the trading size based on your own capital. And it's completely fine to start small. You can target just $5 to $10 profit per day. Then, if you're able to do that consistently, you can then begin to scale as you increase your trading skills and grow your capital. Now, let's get into the specific position sizes and money management that you should use. So, assuming that you have a $5,000 portfolio, you want your position size to be $500 for each trade. Next is profit target and stop loss. So, from your $500 position, you want to target 20% profit per trade and stop loss at 10% per trade. So for each trade, your maximum win will be $100 and your maximum loss will be $50. Now I know what you're thinking, but how do we possibly catch a 20% movement from one trade? Well, the answer to that is by using margin or leverage. So margin can be a double-edged sword. If you use it carelessly, it will blow up your account. But if you use it with the right risk management, it can be a powerful tool for traders who want to grow their account. And so for this strategy, I recommend using 5 times margin for each trade. So from your $500 position size, set the margin to 5 times. Now, because of this, in order to reach our initial 20% profit target, the asset that you bought only needs to rise by around 4%. Because 4% multiplied by 5 times is 20%. Similarly, our stop loss target will be hit if the asset drops by only 2%, because 2% multiplied by 5 equals to 10%. But bear in mind that this calculation does not include fees. But to summarize, for each position, you invest $500, then you aim for 20% profit and 10% stop loss. Next is trade frequency and time frame. So I recommend taking a maximum of 4 trades per day, trading on the 15 to 1 hour time frame. Next is the target win rate. I recommend targeting a 50% win rate, which means you're aiming to get 2 winning trades per day out of your total 4. But of course, if you can aim for higher, that would be much better. Now, I get that some of you might still be confused, so here's a practical example to hopefully clear things up. So, let's say you enter a position because you spotted a bullish 3-bar pattern forming in this chart. And based on our guidelines, you enter a buy position using $500 with 5 times margin. Now, because you're using 5 times margin, each percentage point up or down is multiplied by 5. So in order to achieve our target of 20% gain and 10% risk per trade, you want to set the take profit at 4% and stop loss at 2%. By doing this, for every losing trade, we would only lose $50, and for every winning trade, we would gain $100. That means if you had 1 losing trade and 1 winning trade, you'd still be up a total of $50. Next, if you do this 4 times a day, assuming you get a 50% win rate, which equates to 2 winning trades and 2 losing trades per day, you'd make a total of $100 for the day. And so, that was the exact method on how you can earn $100 per day by trading the 3-bar pattern. Now remember, the more you practice this strategy, the better your trading skills will become, which will increase your win rate further. Now, if you want more simple and easy to understand trading tutorials like this, you can check out my other videos here. So thank you for watching and I'll see you in the next video.